All right, guys, how's everyone doing? Sorry for being a little late. Had some fires to put out. Kind of a crazy trading day today, as almost every day has been. But we're ready now. Whoops, one second. There we go. So in the chat here, can you just to make sure everything's running okay? Can you guys tell me if you can see me and hear me okay? We're going to go over 2018 trades. Today, we're going to go over the top 10 trades. And what I mean by top 10 is not only the best trades, but the worst trades. So it's really going to be the 5 best trades and the 5 worst trades. So we're going to focus on these 10 trades because I think they'll tell us a lot, and they do tell us a lot about how we should be trading in the trading year. All right, thanks, guys. Looks like everything's okay here. So what I'm going to do is I'm going to get off me here and get to sharing my screen. So give me a second here, and you should see a spreadsheet here of the trades we're gonna go over. Some key points. And what we're gonna do is we're gonna talk about the wins, we're gonna talk about the losses. With the wins and the losses, we're gonna talk about the setup and the strategy. And actually both with the wins and losses, because there are some mistakes that can be made with wins also. So we're going to talk about the mistakes. We're going to talk about why these trades were good or bad, and any key adjustments we made. Before we begin that, let me talk about number 3 here, key macro level points. That's not specific trades, but our trades at a macro level. Number 1 is the risk ratios and the size of our wins versus losses. I want you to pay attention to that here. Notice 5 wins, 5 losses. I think I have actually 6 wins in here. We're not going to go over the LOXO trade. But notice a key point. You guys are probably already seeing this, and that is the wins are much bigger than the losses. So if you look back, and I want you guys to, all of you, to do this, look back at your biggest winning trades, look at your biggest losing trades. And what I'm hoping I see from you guys, and you guys can go ahead and email me at singjd1@aol.com. If you want me to go over some of your trades, I'll do that. I'll send you a quick email. But one thing we're going to notice here, or we're going to want to notice, and you're going to see here, is wins were much bigger than the losses. These are the biggest wins and the biggest losses. Notice that my biggest loss was 2,500, and then we had a 2,200, 17, 18, 17. And these were actually some of our smaller wins. If we took our normal wins out, this was kind of the normal win size, but our biggest wins were 4,800, 3,000, 3,000. So they're basically over double the losses. So if I just took these 10 trades, even though it's 5 for 5, 50% win rate, we're actually up big because the wins are much bigger than the losses. That's how you want to be trading. That's the idea behind the trading. You don't want to, on a macro level, you don't want to rely on a really strong win rate. That's very hard to do. What you want to do is be trading somewhere between 40 and 60% on the win rate. Obviously, we don't want to be at 40. We'd like to be at 50, 60, 65%. But 40% is fine if you're getting the 2-to-1s, the 3-to-1s, the 4-to-1s. Basically, if you've got a 2-to-1 win rate and you're trading a 2-to-1 risk ratio, meaning for every $2 you risk, you're winning $1. If your average loss is 1,000 and your average win is 2,000, that would be a 2-to-1 risk ratio. If you're winning 40% of the time, you're ahead. So, and we were up, I think on the year, I'll have to look back in my 2018 stats. I think it was around 55%. And we were up 30% in a year that the market was down about 7%. So it was a really tough market to trade. I know a lot of you guys follow me on Twitter and Instagram here. You guys have posted this stuff. Hedge funds were down on the year. The average hedge fund was down significantly. The market was down. So if you were green this year, you got to pat yourself on the back, even if you were only up 1%, because you did a really good job. So that's kind of on the macro level before we actually dig into the trades. The other thing, it's really important to trade with the market trend. If you're trading with the trend, you're probably winning. So When the market is going up, you want to be trading to the long side. When the market is down, you want to be shorting or out of the market, depending. If you don't like to short too much, at least be out of the market. But to be a good trader, you do need to be able to short. Now, over the last 2-3 years, I'd have to look at the statistics exactly, but I think I've been about 75 to 80% long. And I've been getting questions, like, "Hey, do you not like to short? Why do you go long so much?" I love to short, and especially if you look at my day trades, I short a lot. But this is swing. In swing, you have to go with the market to be successful. So you should be trading with the trend. And over the last 2-3 years, for the most part, I would say at least 80% of the time, the trend has been to the long side. I mean, let's just pull up SPY here. I'll just pull up the weekly, and you can see going back to 2016 here. So essentially, the last almost 3 years, the trend has been to the long side until now. We had a little blip here, a little blip here, some pullbacks here that you could short. There was a big pullback earlier in the year, and then this pullback in here. So through this period here, 70 to 80% of your trades should have been to the long side. And even 2018 until October, a majority of your trades, except for this period in here, should have been to the long side. And that's what we did in 2018. Essentially, we went heavily long in this period, and it was a really nice period. And then we shorted the heck out of the market, once October hit. So you got to go with the trend. Essentially, if you were long April to October and you were short or out of the market October to now, you're doing really well. So that is a key point. You want to be trading with the market. The other key point here, and we haven't had to do a lot of it because the market has been in an uptrend. When the market is in an uptrend, you want to be trading relative strength stocks. Now, let me actually switch back here and talk about leveraged ETFs. For those of you who don't know, I know a lot of you following me should know this, but leveraged ETFs take whatever they're tracking and they add leverage to it. So for example, let's just quickly look at SPY today. SPY is up pretty nicely today. It's up 1.1%, which is great because we have a long position in SPY right now. But SPY is up over 1%. So now if we take the leveraged ETF of SPY, so you could trade SPY directly, but we want extra leverage. We're momentum traders, we're swing traders. We want the biggest gains we can get. So what we're going to do is trade the leveraged ETF. And you're going to see a lot of my biggest wins this year were UWT, SQQQ, SPXS, TZA, TQQQ. These are half my trades, half my biggest trades. Actually, I think all of my biggest trades, except for Netflix, LOXO, Tesla, a lot of my biggest trades were the leveraged ETFs because we get extra leverage on them. So if we take SPY and you look at SPXL, you can see here XPL is up 3.66. Basically, this is tracking SPY with 3 times leverage. If SPY is up 1%, SPXL is going to be up 3%. And they don't track exactly. You might see some minor differences because they do have their own supply and demand. But if you look at SPY here, when it's down, it'll be down 3%. So up 3%, down 3%. Eli, you can take a look at any of these trades here. Take a look at the alerts. They track. They should track exactly. If there are some differences, let me know. But there is nothing wrong with these trades here. Go ahead and take a look at them. Okay, going back to SPY here, up 1%, 3%. Now, if we take the leveraged ETF and compare that to stocks, there are very few stocks here that are going to beat the leveraged ETF. I could even look at my watch list here. SPXL is up around 3%. Today, we might find a lot that are beating them, but on most days, you're not going to do much better than the leveraged ETF. And that was true in here. If I would have traded a stock in here, probably would not have gotten the gain that I got by trading these leveraged ETFs. So remember that. Think about the leveraged ETFs, especially in a bear market. When the market is tanking, you can basically forget about all the stocks and just look to short either the leveraged ETF or trade one of the inverse ETFs. So, for example, with SPY, I just showed you SPXL. The inverse of it is SPXS. So if you look at SPXS here, it is down 3.5% here because the market is up. But when you want to short the market, you can go long one of these in here. And basically, this makes it easy, especially if you don't like to short. You can just go long these things. And it's essentially like shorting the market. So pay attention to leverage. Remember these on a macro level when you're trading. Risk ratio, very important. As long as you're winning more than you're losing, it's likely that you'll be successful. And at the least, you're probably not going to take a lot of losses unless your win rate is really low. You'd have to be around like a 25% win rate to start getting significant losses. Trade with the trend of the market. Now, obviously there is a skill in figuring that out. And we do a lot of things in the report, market breadth, analyzing trends, all that kind of stuff, and that'll help you figure that out. Go ahead and read my past blog posts, or if you're a member, obviously listening to the reports every day, we really focus on what is happening in the market. And then remember, leverage ETFs. Okay, that's enough about that. Let's get to the trades now. So we'll just go in order. We're going to start with a few losses. Now, to start the year, we ended up crushing the market, up over 30%. The beginning of the year, and we've had a webinar on this, we've talked about dealing with drawdowns. March to April, I was actually down 4%. We had to deal with a drawdown. Now, the question is, when you're in a drawdown, are you trading poorly, or are you just on the wrong side of probabilities? We're trading again at 55, 60% win rates, sometimes even lower than that. So 50, the setups we trade, there is no setup that's like a 90% success rate. At the best, you'll find a setup that wins 65, 70% of the time. So obviously you're going to lose, maybe 25, 30, 40, 50% of the time. So you have to ask yourself, am I trading poorly? Is there anything I could have done differently? Or am I just on the wrong side of probabilities? I know we all deal with drawdowns, even the best traders. You look at Warren Buffett, he's had years that were pretty bad. And you look at all the great traders. So if you go through a drawdown of a couple of months, you have to analyze it. We analyzed it. And you can go back to our webinars. The conclusion I came with was, one, we were on the wrong side of probabilities, so that was fine. I was taking good setups, and you're going to see that when we discuss these trades. The setups were basically fine, but my risk wasn't. So the big adjustment I made around March, April was I decided I really had to focus on my risk more. I could not loosen stops. So with the size account, with this account, 100,000, it increases to like 130 now. But at 1% risk, I should not be losing more than 1%. Sometimes when you're dealing with risk, you do have to loosen it a little bit. So I'll go to 1.2, 1.3. But when I was looking at my trades, there's no excuse for going up to 2%, 2.5%. Some of these were gap downs, but we still loosened it a bit. So let's take a look at some of these. The first trade was Roku. And let me pull up the image here. So you can see with Roku, the entry was right here. Actually, this is one of the trades where I would say even the entry was maybe questionable. So the setup was a gap down reversal setup. So you can see here, the stock was very strong, had run from 20 all the way up to 60, had consolidated in here and gap down. Now, one of my favorite setups is the gap down reversal. I like these stocks that gap down and then put in a reversal pattern, especially if the stock is a strong stock. And that is what Roku was. So the setup was okay. The reason I said here that in my comments that it was questionable is because I like these to gap down to a support level. And as you can see here, it didn't quite gap down to the 50-day moving average. So, maybe I could have not taken it because of that. But, it was a reversal candle, and a lot of these will bounce here. Obviously, this one didn't. Now, I didn't go back and look at exactly where my stop was, but just looking at the setup here, my stop was probably right around this level here. And as you can see, I got out here. So if I would have got out at the initial level that I was going to get out, instead of a 1785 loss, it probably would have been around 1,000. So I would have saved myself $700. And over time, that it doesn't sound like a lot, but over time, a lot of trades, that does add up to a lot. So obviously I made a mistake here. I was actually right in the sense that I thought this thing was going to bounce back. And I ended up getting out at the worst time. It did bounce back. And if not getting a gain here, I'm not sure if this would have hit my target level. At the least, I could have got out at break even. So instead of a loss, I would have been at break even. So I would have saved $1,700. So not the best trade here in terms of trade management. I always break these down into three things. How was the setup? I would say the setup was okay. Maybe I'd rate myself a B on the setup. Risk management was poor, 1.7%, too much. I should be around 1%, maybe 1.2%. And trade management was not good. So this was not one of my best trades. So that was Roku, not a good trade. Now let's get to, and you can see these losses. The point of these is these losses all could have been improved on. And, all of these 5 trades where I probably ended up losing a combined maybe close to 10,000 on these. I probably should have only lost 5, and that would have had a 5% impact on my trading. So now let's get to Netflix. And if we look at Netflix here, comments, trend pullback entry at support. This was a good entry. So if we look at here, this thing ran up, pulled back here, and put in a hammer candle right in here. Really nice hammer. Textbook pullback entry to the breakout level. This is a trade I would take every time I see it. Actually, I'm looking at the wrong trade. Sorry. That's this trade here. But okay, we're going to skip down here to 220. Is that 226? Sorry about that, guys. Oh, okay. Sorry. It's this trade here. This was a good trade. Not the trade we're one of the trades we're pointing out here, but this hammer was a good trade. This trade was also a very good entry. So my entry was here. Another good entry. Now, it did not work. It was a breakout, pullback to support, and we see strength at the 9 EMA. There's another setup I would take every time I see it. Now, obviously, it did not hold that level. That's okay. What I should have done was got out right here. I think at this point, I thought maybe it would remount, but actually there was really no excuse for holding on to this here. I should have been out instead of 22.98, loosened my stop, thought it could hold this bottom of the breakout level, bottom of the breakout bar, which it did. And then it pulled back in here. Now I was right in the sense that it did end up holding, but you just can't take on this much risk. And it got to the point where I had to get out, and I got out, I increased my risk, and I ended up stopping out at the bottom, essentially at the worst time to stop out, because then it did do exactly what I thought it would do. Now, how do I adjust for this? If logically I knew this is still a good setup, it's showing strength, what I should have done is instead of increasing my risk, I should have got out here and waited for the next setup, waited for this, and then took it. So then I only lose 1,000, and then I get back in and I get the win. I actually did, and it's not on this list here because it wasn't one of the biggest wins, but I did end up getting out, getting back in, and profiting in this area here. But this loss was way too big. So as you can see, 2 losses where my setups were okay. If I'd managed my risk, instead of this being close to $4,000 in losses, I would have been at $2,000 in losses. That's a 2% difference in your overall results. So decent setup. I'd probably give myself a B+ on the setup. Risk poor, trade management poor. All right. Setup trade number 3, TQQ. Now, this was the biggest loss of the year at $2,500. Rubber band setup and remount. And the setup was totally fine on this one. Let me pull up the chart here. That was on 2/6. We can see right here. This was the entry. So you can see TQQQ is one of those leveraged ETFs we were talking about. So it's tracking the Qs, so basically technology. You can see a big run here. There was the big pullback. And look at this fantastic candle here. Those of you, I know some of you watching were probably day trading it, but exactly what I want to see in a rubber band remount type reversal setup. So rubber band setup is when a stock gets very beaten down and puts in a reversal candle and looks ready to bounce. Now, that didn't end up happening here, but it was a textbook setup. So I'd give myself an A on the setup. Now, the problem was where I exited. What I should have done, my entry was up in here. And what I should have done, and the prices are different on these because this thing has split. So we're not going to see the same prices here, but the candles are exactly the same. So, at some point, I entered up in here when it was showing strength. My stop was probably somewhere in here. And you can see I got out way too low here. I probably wanted to see, is this thing going to reverse? And obviously, on a lot of these, you end up being right, but your risk just gets to be so much that you have to get out at some point. And I was at a point where I was down 2.5%, and I just can't be down that much, and I had to get out. So I should have been out here, should have been a $1,000 loss, maybe even $1,200, $1,300 would have been fine, but not at that $2,500 level. So key adjustment, again, should have been get out at 1%, maybe 1.2%. Now, another adjustment I could make is get out at that 1%, and then if you get that signal, go ahead and get in. And we'll go to the next trade now. Finally, we get to a win. And as you can see here, this big win, $4,800, actually basically covers 2 of the biggest losses. So if we take a look at that win here, let me pull this back up again. You can see now we got that strong hammer, rubber band setup again, strong hammer entry, and we got out here, $4,800 win. So we got out at least 4-1 on this. So this is what we want to be doing, getting these big wins. So rubber band setup, not a lot to talk about this. We executed it perfectly. Now, it did run up a little higher. But, at some point, you do have to make a decision to get out. It did consolidate here, and I don't remember if I ended up getting back in when it started to run here. But this is a textbook trade, exactly what we want to see here. So 2 trades here. I don't mind either of these trades, especially the loss here. I don't mind that. But what should have happened was I should have got out at $1,000. So instead of the difference here being about $2,300, so between 2 trades, 50% win rate, $2,300 in wins, this should have been $3,300. So I should have made, or maybe even more than that, cut off $1,500 here. So I should have been up about $4,000 instead of only being up like $2,500. So again, you can see how important risk is. It's not necessarily the setup you're taking. What's important is the risk. Okay, now let's go to Netflix on February 26th, $3,000 win. So I got 3-1 on this. This was an anticipation high breakout. The other thing was the market was strong and we were showing relative strength to the market. And let me just pull up the market analysis here so you can see that. If we take a look at SPY here, going back to February 26th, the market was showing a lot of strength in here. We were coming off this bottom. We had an expectation that the sell-off was over, which it was. It did retest, but then our market analysis was right on point. We had this big run going into October. Now, on top of that, look at where at 226, look at where the market was. The market was still off highs, but look at where Netflix was. Netflix at 226 was already reaching its highs. So while the market was not at its highs yet, Netflix was. That indicated to me relative strength. And anytime we're in a market that's pulling back or a bear market, I always track relative strength. Those of you who are watching me right now, we've been tracking relative strength. We've been watching areas like Brazil, India, software stocks. These are all areas that have been showing relative strength to the market right now. Back then, it was basically the FANG stocks. So this is where I took the trade. Let me pull up the chart that I already took out here. This is where we took the trade. So normally on these things, I wait for the break of the high, which would have actually been right here. I call this an anticipation trade because I actually entered before the big break as it was consolidating because I knew it was a relative strength stock. And if the market started to move, I knew this thing would pop. And that's exactly what happened. It did pop here. Again, textbook setup. We timed this perfectly. When the stock started to get oversold on this area here, we got out. Maybe we could have got squeezed a little bit more out of it, but I was fine right here. And you can see then it pulled back. So we know there was an overbought condition coming. So we got out at that point. So really good trade there with Netflix. And it was at about this point, actually it was more towards March, April, where I made the decision that I was no longer going to increase my risk on any trades. So, we never had a $2,000 loss again at the end of the year. We did have this UWT trade, which gapped down on us. There was really no control on that one. And I think the same thing happened here with TQQQ. So that was a Netflix trade. Now let's actually get to the TQQQ trade. This one was in April. So we can see here, and this was April 17th at 158. And we've got different prices here because it had split. But April 17th here, this is a classic trend pullback remount. So we basically made the decision that we felt the market was going to start trending to the upside. The sell-off was over. This was just a retest, and it was a nice looking retest. It made a higher low. You can see the lower low was here. So I really liked what was happening in the market and the cues, and we got this remount of the 50-day moving average, exactly what we want to see. The market did do what we expected to do, but it did pull back one more time. And this is kind of the same mistake I'd made before where I was right. I knew what was going to happen, but I should have got out and got back in rather than loosening the stop, because there came a point where, again, I almost bottom ticked this, where I stopped out right where the bottom was made because I had to at 1800. I couldn't let it increase anymore. Again, probably the last time I made this mistake where it was a good entry, I increased my risk. Stop placement was tricky on this one because we had the 9 EMA to deal with. The 9 EMA to deal with and the 50-day moving average. And maybe I should have just kept that tight stop at the 9 and then re-entered when it showed strength. And again, I think I did re-enter at some point or use different stocks to re-enter. Okay. That was basically the end of the bad trades. I don't think there was one trade. There were plenty of other losses, but they were all within the $700 to $1,200 range, exactly where they should be. We timed the market pretty good going on the rest of the year. And even this one bigger loss here, this was a gap down that we really couldn't control. So now let's get to the Netflix trade. This was the next Netflix trade. And this was on May 2nd. Pull up the chart here. And you can see here another textbook setup. This was a trend pullback, hammer confirmation. So you can see here the market had the market, you remember what the market was doing. It was starting to run up after a big move down in here. Netflix was one of those relative strength stocks. Off the pullback, I was looking for a reversal candle. We got that here. Hammer at support level, textbook entry. Now, I waited here because I was still a little concerned about the overall market, even though I like this stock. Since we had come through, if we look at the market here going into May, we were still coming out of this kind of ugly period, which was looking a lot right like this. And instead of, currently, it looked almost the same, except this time we went down. This time we went back on trend. So I was still a little concerned. Is this going to be the big drop? So I wanted to wait for confirmation. So whereas I normally would enter on the hammer. I waited for a little bit of confirmation. At this point, I felt like, okay, we're holding. We can enter here. You can see where we entered on the second. We let this thing run. Now, this one was interesting because my initial target was the top of the range, which was right here, which would have given me about 2.5 to 1 on this trade. But because the market had become so strong, if we look at SPY here, by this point, the market was really starting to break out. So because of that, I was willing to hold through the high break, and we squeezed out a little extra on this. Now, at this point, I was sitting on 3.5 to 1, and I didn't want to give up too much gain. So obviously, it went even higher. I could have got a bigger gain, but there does come a point where we have to get out of the trade. I did get back in and trade Netflix again. So we could say we kind of split it up into 2 trades. But for this trade specifically, great risk reward, textbook setup. Again, potentially maybe we gave up a little bit of profit, but we already had 4 to 1. Really tough to beat that. So overall, good trade. Maybe we could have squeezed a little more out of it. Now, next trade was Tesla. Tesla is an interesting trade because it's something we don't normally do, but we had so much short interest. And let me, those of you who don't know this already, if you follow me, you know this, but if you're not familiar with the concept of short squeezes, anytime you have a stock with a heavy short interest and there's good news in that stock, it is very likely that stock is going to make a big pop and a big quick run because the news is going to scare the shorts and they're all going to cover, and that leads to a short squeeze. And that's exactly what happened with Tesla. So as you can see here, Tesla, normally on a breakout like this, I probably wouldn't take it. It's kind of in no man's land. You have to use a really wide stop here. But we knew here there is heavy short interest. There's likely to be a short squeeze. So whereas normally on a breakout, I'm going to wait for it to consolidate for a few days. Maybe I get a pullback play. Maybe I get a high breakout. This one we actually entered on the day of the entry because of the heavy shorts. And as you can see here, it did consolidate for a couple of days, but then boom, we had the big move. If you remember, this is when Musk, he tweeted that thing about 420, and then we got the other big pop. Now, this big pop, obviously there was the news, the 420 news, but on top of that, this happened because of the shorts. If there were no shorts, and I think he knew that too, that's why he did that. Part of it, everyone thought he was an idiot for doing it, but I think there was a method to his madness. He knew there were a bunch of shorts and they could get the squeeze. It did happen, and if there weren't all these shorts, maybe you get a little bit of a pop, but it would have been nothing like this. So this is a lesson to keep in mind. Anytime you see a breakout on a stock that is heavily shorted, one, it's going to be great for day trading, but two, watch it for a potential swing. Now, I didn't end up shorting this thing, but this is another lesson from this, that once all the initial shorts off this news cover, that's often when the stock is going to pull back. And you can see that happened here. I was a little hesitant to do that because there was just so much news. And I didn't know if he was going to tweet again or what was going to happen. Plus, if that buyout actually went through, we could have seen another big pop. So I didn't end up shorting it. But there is a lesson in here. Once the shorts have covered off, often you get a big move down. So really good trade here with Tesla, textbook breakout on high short interest. Exit when you know the shorts are covering. We got a great risk reward on this. Okay, so this basically covers the uptrend in the year. Now, the next three biggest trades are coming through this period here in the market. And let me recap this a little bit before we get into the trades. Now, heading into this period, you'll notice, and again, those of you who follow me, you know this already. And if you don't, take a look at the blog post I posted right at the end of the year here, a week ago, on 11 lessons in trading in 2018, because it focuses a lot on bear markets and market breadth. And we knew already, even though we knew there was a big run here, this was very concerning, and there was some kind of macro news type things that led us to believe at some point we are going to crater. And we were watching market breadth very closely. And I'm going to point out two things here. One, notice that the market was making highs at the end of September. Now, at the end of September, I was concerned about market breadth. And while everybody was saying that, you should be going long here, market's at all-time highs, it's fantastic, this is what we were noticing. First, small caps were lagging. Small caps made their high back in late October, early September. And by the time SPY was making highs in here, small caps were already declining. So this predicted the big move down. The other thing we watch is a T2108. This is stocks making their above their 40-day moving averages. And notice that it made its high way back in June. In September, it was way down here, trending down. So this is a negative divergence. In a strong market where the market is way up here making highs, we would expect T2108 to do that too. So these two things were really concerning. There were some other market breadth factors, but these are two very easy things to track. Always track these things, and this will give you a clue on the strength of the market. Notice right now, T2108 is very strong. It's really starting to pop in here, which means this bounce here, while it may fail, we like the fact that it is showing some strength here. And strength in small caps as well. So small caps are bouncing nicely. You can see IWM is up 2% today, which is stronger than what SPY is, and we like to see that. So this bounce is actually encouraging right now, but it was not encouraging back in September, October. So because of that, we went into our sell-off mode even before the sell-off happened, and we traded this really successfully. So we were, up big while the market was down big during this period. That is where we got these three big shorts: SPXS, SQQQ, and TZA. Now notice I'm calling these shorts, and I put the L/S here because technically we were long, because we were long the inverse index ETFs. But when you're long the inverse, you're essentially shorting the market. So anytime you see LS, I'm essentially short the market, even though I'm having to go long these things. So let's pull up SPXS here. Now, one key thing about bear markets is you don't want to short when the market is extended to the downside, because often there is going to be a reflex bounce. So look at this first, and every time we've had our big winning shorts, what we've done is we shorted off a bounce failure. And that's what we did with SPXS. Now the market crashed here. We could not short in this period because it was just too risky. We know in bear markets, there tend to be very strong bounces, and there was one here. Now, the question when you see a bounce is it a dead cat bounce, or is it going to be a bounce failure? So you watch the bounce, and if it starts failing at a resistance level, that's where we look to short. And that's what we did with SPY. It started to fail at the 9. Now, if it would have broke the 9 here, we would have gone long. But it didn't do that. It failed here. And when it failed here, that's when we shorted. That's when we took the SPXS position. So you can see here, as it was failing, we went long here, and that's when we got the big pop. So when this thing crashed to the downside, SPXS pops to the upside, and that's exactly what we did. We got in here, and as it got extended, we got out, and we got the almost $4,000 win here, essentially 4-to-1 on our trade. So textbook bear market dead cat bounce failure, textbook setup, great RR. Now, I want to mention this. Some of our members had issues with micromanaging, and that's something that is really difficult in bear markets that, these things sometimes don't go down in a straight line, especially if you're watching intraday. There are a lot of spots that can get a little scary. It might look like the market's reversing. Specifically with this trade, a lot of members didn't follow the alert, which is fine. You don't have to follow my alerts. Alerts are just guides. You trade however you want. But a lot of you guys got out here and you ended up with a small win. So instead of the almost $4,000 win, you ended up with maybe 1,500 or two, or well, depending on what your account size is, you only got 2-to-1 instead of the 4-to-1. So you have to stick with these things in these bear markets because there's going to be a lot of volatility, and you just gotta set it and forget it. We talked about that on a macro level early on. You got to put on your trades and basically stick to your guns. And that's what we did here, and we got the big win. If we watched every tick, we would have never got any of these big wins. Now, the next one was TQQQ, and that was basically around the same time. SQQQQ. It's basically the same trade, just a different vehicle. Instead of SPY, we were trading the Qs. We don't really need to get into this too much. It is the exact same setup here. And then finally, our last trade to go over, UWT, basically a gap down. And it was a good setup, gap down, and there really wasn't nothing to do. So, these trades were poor trades. These all should have been $1,000 losses. This one, our risk was okay. It gapped down on us, and, we just had to take the bigger loss there. Then finally, TZA, this is the most recent one. And again, it's the same thing. And let me actually take a pull up IWM here. And you can see here on the 4th, that is when the market started to fail. That's where IWM started to get crushed and had this big drop down. Now, there is a mistake in here, but it was a huge win. So you can see as the market was getting crushed, as the market was failing, TZA, the inverse, is showing strength. And that's when we got in. We got this huge win. At some point, we do have to get out of these. We're sitting on 4-to-1. Now, it is a little frustrating because it did run way higher than we expected. And, instead of 4,000, maybe I could have got 7,000 or 8,000 on this. So bear market, dead cat bounce failure, like the last 3 big wins. Textbook setup, great RR. Huge win, but my question is, could I have gotten more out of this? Maybe, I don't like to partial because it decreases the amount you can win when you end up partialing. So maybe I could have let this ride. Maybe I loosen my, just keep a trailing stop on this thing and let it go a little bigger. I'm still questioning myself on that, whether I should have done that. But again, it was still a big win, double the biggest losses and triple my average loss. So that's the 10 trades here for 2018, 10 of the biggest trades. We're going to do these things maybe every 2 or 3 weeks, these public webinars. For those of you who are members, we do group mentoring sessions. I'm going to have one tomorrow where I'm going to have a lesson for the students, and then we're going to do a question and answer where we do get into some mentorship. So thanks, guys, for watching this thing. These were the trades for 2018. I think next time, maybe I'll do an open Q&A for you guys, even those of you guys who aren't members. So think about what you want to ask me. Watch my tweets, watch Instagram, any blog posts, trades of 2018, some of the blog posts we've done. If you have any questions, ask me on the next webinar. And remember, you can sign up for Bulls on Wall Street Swing Trade Service. And I think there's some good deals right now if you sign up for a year. All right, guys, I will see you next time.